Welcome back to the Legacy Radio Network. I am your host, Dennis Tubbergen, and we are chatting with Chris Martenson. Chris is the author of The Crash Course, a book that I read when it came out. I would highly recommend you do the same. Chris, thanks once again for joining us today.
My pleasure.
In a recent blog entry, Chris, you asked the question, are we heading for another 2008? Give us your opinion as to where we're headed economically speaking. Are we headed for now a meltdown of sovereign debt? Have we just shifted the excess debt from the private sector to the public sector? How's this all going to play out?
Well, unfortunately, both those things that you just mentioned have happened. The Federal Reserve, the U.S. government, in Europe, the ECB, in Japan, we've seen the same story play out again and again, which is that once we reached debt saturation and the consumers could no longer take on anymore, it just didn't make sense, and they started to pull back. We went through classic Keynesianism where the government stepped in and said, well, we'll do the borrowing. And so there was this extraordinary shift of borrowing from the private over to the public sector. And I think they had their fingers crossed saying, let's hope that this turns around soon. Well, we're 3.5, almost 4 years into that, and it hasn't turned around. I know people say, well, look, the U.S. economy is strongest across the globe, and it's still growing, if tepidly. But you have to understand that's with 8.5% deficit spending, 8.5% of GDP by the federal government. It's an extraordinary level of expenditure. The U.S. government just posted its largest ever monthly budget deficit for the month of March, had a record in February. Clearly, that's an unsustainable trend. So even with these massive amounts of printing, with the ECB tossing €1 trillion into the system, Federal Reserve doing what it's doing with the federal government deficit spending, we're still limping along, and that's because the original problem was too much debt. Now, if you want a view of how too much debt finally plays itself out, we can look at Greece and now Spain. Spain is the next canary in my coal mine. Their interest rates are sneaking back up. The banks had this big bailout, which they used to buy sovereign Spanish debt. It drove the yields down, but those yields are now spiking back up, and they got another bailout. And it looks like the banks in Spain are underwater on their bailout, which they got from the bailout, which bailed them out. It's just an endless string. So what I'm looking at here is we have to look at the economy now as this global organism, particularly the financial system as a global organism. If Spain goes down and it gets into a Greece-style problem, I'm looking for an extraordinary financial crisis in Europe to erupt, which means we're going to have an extraordinary financial crisis in the U.S. as well, because they are too interlinked at this point. There's really no way to cleave them apart. So those are the pressures I'm seeing. I'm a little disappointed that we had a crisis in 2008. That was the warning shot across the bow, and instead of taking the lessons from that, which was, wow, we better reduce some of these imbalances. This would be an opportunity to deleverage. This would be a time to figure out how we're going to set priorities and maybe live below our means for a while as we work some of these debts down. We went the other direction. It was like doubling down at the craps table and said, you know what, let's just see if we can pile more debt on and have this thing work again. We have 100 trillion more derivatives than we had in 2008. Don't even get me started on where we are with debts and deficits in the U.S. This theme of trying to fix a problem rooted in too much debt with more debt, I think, is going to be a failed policy.
Well, Chris, I certainly agree. And when you look at Europe, to go back and revisit that for a moment, you have Spain, but behind Spain we have Portugal. Behind Portugal we have Italy. This is not a problem limited to just Greece and Spain. And our listeners out there that are listening to you talk, and you use the term financial crisis in the United States, how would you explain to a listener, in your view, how this might affect an American investor?
Well, everything's interlinked at this point in time. One of the things we've noticed over the past, 10 years, it's been creeping up, is the degree of intercorrelation between all the markets. Once upon a time they said if you really want to be diversified, you have stocks and bonds. And then they said, well, stocks in the U.S. and in Europe, or, foreign stocks. And none of those really work anymore because all the markets go up and down in lockstep, pretty much. They're very highly correlated. And so the lesson we take from that is that all of our investments, which we tend to think of as, over here in the U.S., they're not really U.S. anymore. 40% of all revenues for S&P 500 companies come from somewhere else besides the U.S. So all of the stock markets are highly correlated, and everything is correlated around the U.S. dollar. And so if Europe starts to fall apart, we're going to see some extraordinary things happen. First of all, if the European Monetary Union falls apart, all of these giant funds, these huge amounts of money that need to suddenly get out of euros, where do they go? Well, they'll probably pile into U.S. dollars. I would expect a rather dramatic and sudden strengthening of the U.S. dollar as a consequence of that, which, when we look at the correlations, that'll drive the U.S. stock market down extraordinarily. And the Fed will be stepping back in to try and prevent that. And so we're just going to be seeing, really, to me, we're at the end game of central planning. They've tried to engineer money to a place, a level it's too low. They've been trying to forestall some of the effects of taking on too much debt. They've tried to prevent institutions that really should fail from failing, and in some cases, whole countries that really should fail from failing. And honestly, there's really only two ways out when you get into too much debt. You either live below your means for a really hard period of time. That's the austerity program. Greece is trying it. It's a really painful exercise. Or you have to just fundamentally default on your debt in some way.
Yeah,
and
you have to pay it or say, hey, I'm not going to pay it.
Yep.
This massive money printing that we're seeing, all the central banks, I think I read that the 6 largest central banks around the world have expanded their balance sheets from about $5 trillion 5 years ago to about $13 trillion today. Again, it goes back to if something cannot go on forever, it will stop. Will there be a currency that returns or a country that takes their currency and links it to gold? Is that how this is going to end? Because now we're seeing this massive worldwide devaluation of currencies. Where does it stop and how does it stop?
Well, we are in this competitive devaluation game. Everybody's trying to have their currency be the weakest. It's really the only way to get out of this predicament. And we could do worse than looking over and seeing what happened with Iceland. Small country, 300,000 people got in huge trouble. Their banks did what all the banks were doing. Instead of swallowing those losses, the people of Iceland said, you know what? No, we're going to stiff the banks. We're going to not honor their debts, and we're going to allow our currency to take the shortfall for this. The kroner fell extraordinarily. They had 2 or 3 years of very high inflation, and now they're on the road to recovery and doing quite well. That's what Greece would like to do. That's what Spain would like to do. That's what the U.S. would like to do. It's what Japan would like to do. Everybody can't devalue their currency all at once. And so I'm predicting that within the next 5 years or so, we're going to have a really an extraordinary currency crisis, one in which we're going to have to scatter about suddenly and come up with a new currency system, something that works, that can balance accounts across nations, that is an auto-leveling function that's not really subject to political manipulation. And we only have one historically that we know about that works, and that's the gold standard. I'm sure people have thought of other ones that might work, but we only have one that's tried and true and tested. And so that's one of the reasons that I hold gold, is for the option value embedded in the idea that someday we might, or somebody or the world might, return to a gold standard. And then we ask, well, what would gold be worth under that regime? Well, it's some significant multiple of its current value. And that's a very speculative sort of a position and reason to hold gold, but it's got a high enough probability that I consider it to be a very attractive speculation to undertake right now.
Chris, I want to shift gears just a moment because you write a lot about energy and you've done a lot of research in that area. What is your outlook for oil and gas prices, say, for this year and then longer term?
Well, I'm expecting oil prices to remain very high. Gas is a different story because gas doesn't ship nearly as well. Oil's easy. You put it in a big boat and you can put it anywhere. So it's a global commodity. Gas is harder because, LNG, you lose a lot of the inherent value of gas to compress it down and liquefy it. Otherwise, you have to ship it by pipeline. So the United States gas prices are very low. They're about to hit a 10-year low, and they probably will. And they're going to remain that way for a while because we've had this extraordinary explosion in natural gas prices, explosion in production of natural gas because of all these new technologies. But we don't have any place to put it or ship it at this point, so that's a U.S. story. Natural gas prices in Europe are an entirely different matter, and in Asia, an entirely different matter. But oil prices, what we're seeing worldwide, this couldn't be any clearer at this point in time. The worldwide price for oil is $120 a barrel. especially for the grades that we want, which are the light sweet grades, which are in especially short supply. It's been this way for a number of years, and that is a serious story that's going on right now. I'm surprised it isn't commanding more attention, but it tells me that we are at that magic plateau where we're having a lot of difficulty getting more oil out of the ground. And we're doing it in places, and we're it's happening. But the other story is that existing fields are depleting very, very rapidly. So, Argentina's production is falling off, Mexico's production is falling off, the North Sea production is falling off, et cetera. And that rate of depletion is just almost being matched by new projects coming online. So we're holding across steadily, but world demand is still going up enormously. Not in the Western countries, OECD countries, very steady, sort of flat to declining oil consumption patterns, but look at Asia and look at the rest of the developing world, and they are just growing by a whole double-digit percentages year-over-year basis. That's the story we're in right now. So I see oil prices holding firm, and within the next 1, 2, or 3 years, when this concept really sort of is publicly talked about in the open across the international landscape, we will see oil prices that are multiples of where they are today.
Which is bad news for those of us that consume energy. If it's going to hit us in the pocketbook.
Well, already the importing nations are spending about $5 trillion a year on oil imports, and that's probably going to go up. So that does represent a loss of wealth from the developed nations to the oil-producing nations, and I expect that trend to continue for a while.
Well, Chris Martenson, thank you for joining us today. Again, the book is The Crash Course, and Chris, we have 10 seconds to give the website.
That's chrismartenson.com, martenson.com.
Terrific. Thanks for joining us. Everything Financial will return after these words.